All right. Today is Wednesday, March 29th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Let's begin with this. It seems like we have two crowds in this market today. We have the adults versus the babies. The adults know that what's going on right now is we got inflation, the highest in 40 years. The Fed is way too late to the game. And to get the job done and tackle inflation down, they have to induce a recession. And in doing that, the most overvalued stock market in history will not hold up. We'll have to go down. We have to see multiple contraction in a big way. Or on the other hand, we have the other side. You can call them the bulls. We can call them the babies for the purpose of this video because their entire argument revolves around, oh, the Fed will give us candy again. They keep moving from one argument to the other, twisting and turning and getting ahead of themselves. And it seems like the adults have no other choice but to step back and watch the show until the babies run out of arguments. What am I talking about? This year-to-date rally started based upon the argument that, hey, inflation is cooling down, and we have strong job growth. I'm not going to say strong economy because we've been having abysmal economic indicators, be it leading economic indicators, be it PMIs, be it Fed surveys, it doesn't matter. But so far, we have an intact jobs market according to the data. And the argument in the beginning of the year is you got to start buying stocks right now. Stocks are cheap because the Fed is going to pivot. There is no point in raising rates anymore. Inflation is going down, the job is being done, and oh, by the way, the economy remains strong. It's holding right now. So this is exactly the kind of argument that you want to hear to start buying equities. And of course, in this channel, we've been warning about rebounding inflation, that inflation is going to rebound higher. You got to be careful what your assumptions are. And what do you know? We got more data, be it the CPI, PPI, PCE, doesn't matter. All of them indicated that inflation is actually rebounding, moving higher again. And therefore, the whole declining inflation part, that's not true, which takes the Fed pivot out of the table. Then the babies came up with another argument. Wait a minute here. What if the Fed continues to raise rates and the economy can handle it? Because we're not seeing any damage in the employment market. We still see jobs plentiful. We continue to create jobs at a historic pace, and therefore we have the soft landing. The Fed can raise rates as high as they want. Doesn't matter. The economy will be able to absorb it, and we will have a soft landing. And then when we got the news that Silicon Valley Bank blew up and more banks followed, the conversation turned into what about the balance sheets now? Not just for banks, but for corporations entirely. All of a sudden, the soft landing argument went out of the window too, because you're not going to have a soft landing when it is clear that the economy cannot handle rising rates. We have a lot of debt, we have a lot of risk taking, and higher rates will blow up a lot of parts of the economy. Then the babies said, okay, no pivot, no soft landing. But wait a minute, what if we do have a banking crisis right now, which comes with recession fears? If we have systemic risk in banks, if the Fed continues to raise rates, we're going to have a major recession. The Fed doesn't want that, and therefore the Fed is going to pivot. So now we're back to the pivot argument. That the Fed will give us candy again because we're back to pivoting. Even though the Fed raised rates with 25 basis points and indicated that no rate cuts coming. But the baby crowd continues to say, oh, the Fed doesn't know what they're talking about. The Fed is just bluffing. We've been hearing this bluffing argument, by the way, all the way since last summer. And the Fed continues to prove them that they're not bluffing here because they're guided by inflation, not the other way around. If inflation continues to rise higher, they have to push rates higher too. But this fear of a recession and systemic risk and hoping that the Fed will pivot based upon this argument is keeping the market alive by keeping money flowing into the market based on this assumption that the Fed will pivot and we have to get ahead of it. In doing so, the market is committing three classic mistakes. Mistake number one, fighting the Fed. Mistake number two, FOMOing ahead of the news. Buy the rumor, sell the news. Number three, they're stampeding to buy the most overvalued stock market ever, given the circumstances. When in reality, what we have in the economy right now, sticky inflation plus declining economy, which produces stagflation. And in stagflation, the Fed will have to continue to raise rates to take the inflation part of stagflation out, and this produces a recession. Stagflation plus rate hikes will lead us into a recession either organically or by systemic risk, more things blowing up. And this is not going to be a good outcome for the stock market. It's never been. But in chasing FOMO based on the assumption that the Fed will pivot, it's not just the classic mistakes that the market is committing, but also more risk is building on. Take, for example, the 0 day till expiration phenomenon in options. That's gathering more steam by retail investors now. That's more risk being built on. And the higher the market go, the riskier it becomes because it completely ignores the inflation part, assuming that inflation is gone. But what if it's not? What if rates have to continue to move higher? Then the higher the market goes, the more expensive it becomes, and more trimming in valuations has to be done. And a lot of excessive action took place so far this quarter. The Nasdaq, for example, gained over 17% this quarter alone. This happens to be the highest gain since Q2 of 2020, when the Fed initiated the tsunami of liquidity, not cutting rates only, but over-stimulating the economy with liquidity. And of course, the difference between now and then is the inflation problem. Now we have inflation. Back then, we did not have inflation. So the Fed is restricted. What they can do, what they can't do. Furthermore, part of the excessiveness that built on since this rally began year to date is the AI mania. A lot of stocks went out of whack, lots of FOMOing going on based on the perception that AI will be good for revenues or good for profits years from now. But what about the immediate run that we have right in front of us? If you say we're getting into a recession, we have recession fears, then what would that do to corporate earnings and revenues? But of course, it appears that the AI mania is reaching a peak. Today, Elon Musk and more than 1,000 AI experts signed an open letter calling for a pause on AI development. I mean, when I ask ChatGPT for the best direction to the restaurant and instead it tells me to divorce my wife, take my pants down because it wants to give me a blowjob, yeah, things went a little too far. But things went way too far when it comes to the equities market and the valuations that we have right now. If we look at the top valued companies in the world, Apple, Microsoft, based in the US of course, Alphabet, Amazon, Nvidia, and let's lump Meta into that, forget about Tesla for now. If the argument is, oh, the Fed is going to pivot because we have recession fears because the economy is being damaged too much and the Fed doesn't want to crash it all together, what does that mean for corporate revenues and corporate profits? Will the recession be good for the top and bottom lines of companies? Because this is what the market seems to think so. When we look at Apple, for example, what are we paying right now from a price to sales ratio? Which means what are you paying right now to buy the stock versus what the company produced in revenues last year? You're paying about 6.5 times. And this happens to be one of the most expensive price to sales ratios in Apple's history, meaning the stock is too expensive. But maybe it is expensive because it is recession proof. It's not being damaged. Well, look at what's going on in revenues. They're actually declining. Year on year, revenues for Apple are going negative. And remember, given the price right now, the denominator is revenues. If revenues continue to go down, then the stock will become even more expensive. When we look at the growth for the bottom line, also went negative. So Apple, the largest company in the world, is producing negative profit growth year on year. But somehow that's safety. Now when we look at the growth rate year on year for cash on hand, look at this. Apple is actually having negative growth rate year on year on their cash position. Matter of fact, last year alone, it was down by almost 23%. So again, what am I getting here in buying Apple at 6.5 times sales when I see declining revenues, declining net income, declining cash on hand? Is this really safety? Because that's what I'm hearing on TV all day long. The big caps are safety. You gotta hide in the safety of the big caps. Really? Here is Amazon. When we look at the price to sales ratio, it stands at about 2 times. Now you might say a maverick, but Amazon looks cheap. Certainly cheaper than Apple. You gotta remember this. They keep saying that Amazon is a technology company. It's not. It's a commerce company. It's a retailer. And Americans keep buying from Amazon. So sales continue to be pretty good. Therefore, whatever price Amazon is trading at right now, it's going to look relatively good when it comes to sales, aka revenue. But what about the bottom line? What about earnings? Because, yeah, the company might have a huge volume of sales, but what is the cost in turning this huge volume of sales? The answer is when we look at the forward PE ratio, meaning not the earnings for last year, but the earnings expected in the future. Right now, we're paying almost 40 times future earnings by owning Amazon at this price, which means that the stock is really, really expensive. But what are we getting for paying such a price? When we look at the revenue growth, it is declining. It is nowhere near 2016, 2018, 2020, but be it positive. When we look at the bottom line, net income, that's actually declining. it's going negative. We'll look at cash in hand. This has been going negative for a few quarters now. So what I'm getting by paying 40 times next year's earnings by owning Amazon right now is declining profits and declining cash in hand. How can you justify that? How could you call this safety? Another one, Alphabet. We'll look at the price to sales ratio. It sits at around 4.6 times. And again, you could say, hey, Maverick, Google is cheaper than ever. 4.5 times, that's the deal. Here's the problem. What are you paying for when you buy the stock at 4.5 times plus sales? Revenues are declining, as you can see, and they're about to go negative. Again, in a recession, will Google revenues move higher? Will we see the growth moving higher or down? I think the answer is clear. Profits are now accelerating in a negative trend. When we look at the cash on hand, the growth is negative, not by a little bit, but by a lot. We're talking about north of 20% year on year. They're losing an insane amount of cash. But I'm supposed to pay 4.5 times what the company produces in sales? I'm supposed to pay north of 16.5 times what the company is going to produce in earnings in the future. No thanks, that's not safety. But what about Meta? Maybe that one is cheaper. When we look at the price to sales ratio, 4.5 times. Okay, you might say, look, Meta maybe is cheaper than everybody else. When we look at the forward PE ratio, it's 17 times. Now, what am I getting for paying such a price? The answer is, how about declining revenues? How about declining profits? Accelerating to the downside, by the way, and declining cash on hand. Is this safety? I don't think so. What about Microsoft? The price to sales ratio is elevated, almost as high as the dot-com bubble days, at over 10 times. What am I getting for paying such a high price? The answer is declining revenues. They're about to go negative, and again, in a recession. AI or no AI, ChatGPT or no ChatGPT, in a recession. Are we going to see more or less spending on Microsoft products by the consumers and by corporations? The answer is probably less, right? So revenue growth will go even more negative. When it comes to the bottom line, net income, it's already negative. I'm getting negative profit growth, and I'm getting, by the way, an insane negative growth, not positive growth, negative growth with the company's cash positioning, which is down by more than 20% year on year. Is this really worth paying 10 times sales? Is this really worth paying over 26 times their forward earnings? Is this really safety? The answer is absolutely not. And then, of course, what about Balenciaga, the poster boy for this rally so far? When we look at NVIDIA, it's more expensive than the entirety of the NASDAQ. It trades at almost 2.5 times the earnings of the NASDAQ, which we haven't seen such high valuations since 2021 amidst the insanity. And NVIDIA's price to sales is at about 25 times. You're paying 25 times what the company produced in revenue last year. And when it comes to the forward PE ratio, you're paying over 45 times. But hey, maybe NVIDIA, it's a growing company, so you're getting a bang for your buck. Not really. When we look at revenue growth, that's negative. When we look at net income growth, that's negative. When we look at the cash on hand, that's negative by almost half. The company's cash positioning year on year got cut by almost half. And I'm supposed to pay 45 times what the company's about to produce in earnings in the future. I'm about to pay over 25 times what the company generated in sales last year for these kind of results. But I know AI is going to fix it all. You wait, Maverick, until AI fixes everything. So right off the gate, we have a bad setup. We have a market that's getting ahead of the Fed, fighting the Fed. We have a market that is FOMOing, an outcome that might not actually happen. What if inflation doesn't go down? We also have a market that continues to expand valuations under these circumstances, not reduce them. And the question becomes, in such a bad setup, the possibility of a rug pull is really, really high. How would the rug be pulled? The answer is clear. What is the market ignoring right now? What is the market pretending that it doesn't exist? The answer is inflation. What if we get data that inflation is actually rebounding higher? What if we get data that inflation is actually sticking and not moving down? Wouldn't that scramble the entire argument of the babies now? Because their assumption, once again, is we have systemic risk, we do have recession fears, and this will prevent the Fed from hiking rates anymore. But I keep saying, what if we have a stagflationary outcome in which systemic risk is still here, the banks are not out of the woods, and we continue to see weakening in the economy, the recession fear is here? What if inflation sticks and even rebounds higher? You got to keep in mind that the Fed has a 2% inflation target. What if the Fed has to continue to hike rates amidst systemic risk fears and recession fears? It seems that the market is so comfortable that the Fed will choose letting inflation go because they're afraid of blowing up more banks and they're afraid of a recession. What if this assumption is wrong? And I think the rug pull is going to start by a piece of data that shows that inflation is not going down as much as the crowd is hoping. In particular, a piece of data that suggests suggests that not only rates will have to move a little higher, which will make these insane valuations even less attractive, but it will also cause the dollar to rebound higher. And if the dollar rebounds, corporate revenues will go down, and hence the price-to-sales ratio will expand even further, which means we have to trim these valuations down. By doing what? By crashing these stocks down. In my morning brief today, I discussed the possibility of what if this is that we're seeing today, the gap in the morning, ends up in a gap and crap. Obviously, today did not end up being a gap and crap. But what if it's gonna crap in the days to come? What will be the catalyst? How would the rug be pulled? I gave my viewers this chart right here, the dollar, 4 hours chart. Since almost the beginning of the month, we've been seeing a declining trend in the dollar, but recently the dollar made a higher low. It appears to be on the cusp of breaking and reversing this declining trend. What would be the catalyst for the dollar to move higher? How about data confirming that inflation is actually moving higher or sticking at undesirable levels? It's not cooling down as the crowd is assuming. Then we have to entertain the possibility of the Fed raising rates to tackle the inflation problem and holding their nose while more systemic risk continues to build on into the economy and more recession fears continue to build up. There is no way the stock market will be able to handle that because they're going to run out of arguments. There is no soft landing anymore. We know that for sure. The only argument left is pivot. But if inflation is not cooperating, then there is no pivot. The Fed will have to raise and blow up the economy. And that's the inevitable. That's what we knew ahead of time. But unfortunately, we have to wait for the babies till they run out of arguments. And by the way, we have a lot of indicators that the dollar is going to rebound higher. Take, for example, the crowded positioning in the Japanese yen. Now, yours truly been buying the Japanese yen since last year in my preparation for the upcoming recession. But I have physical yen. I don't care if it goes up or down in the meantime. I know in the long run, when the dollar goes down big because the Fed is indeed pivoting and cutting rates, but for the wrong reasons, which means the economy blew up and the stock market is down over 50% from the top. But until that happens, if inflation data comes out hot, if inflation data comes out showing sticky inflation, the dollar will rebound and the yen will go down. Maybe the overcrowding that we're seeing right now in the yen is a leading indicator for the upcoming rebound in the dollar. And of course, the Japanese yen happened to be the biggest gainer month to date against the US dollar. What is the reason behind that? Recession fears. We got a bunch of banks blowing up. We stampeded to buy bonds. But now we're seeing traders actually reversing that position now that recession fears are kind of cooling down for a little bit because we're not seeing more banks blowing up. So the recession trade is being unwinded. You're seeing gold moving down a little bit. You're seeing oil rebounding higher. You're seeing the Japanese yen starting to lose ground, and soon enough the dollar is going to rebound based upon that. Yet what we haven't seen yet is an unwinding of this big cap technology trade, the concentration on what is dubbed right now as safety, the stampeding and buying technology stocks and the most overvalued kind of stocks because the Fed will pivot. We haven't seen the unwinding of that yet. But remember, if the recession trade is unwinding right now, and the cumulative impact of that is the dollar rebounding, then a higher dollar will take care of the delusion trade, which is long technology and the most overvalued names based on an upcoming pivot. The dollar rises higher because number one, the recession trade is being unwinded, and oh, by the way, number two, we get a hot inflation report, then we will see the rug pull. Big caps will flush down, and with them the market altogether. Most of these overvalued names that have been rallying based on the assumption that we have an upcoming Fed pivot will be among the biggest casualties when the rug gets pulled. And we're getting closer and closer and closer to this outcome right now. We're going to expand on this conversation, folks, but we have to cover the stock market information for you. Now, let's begin with the closing of the indices today, and here we go. We have a rebound across the board, and the Dow Industrial Average closing up positive by 323.35 points, or a gain of 1% even. The Nasdaq leading the pack this time around in the green by 210.16 points, or a gain of 1.79%. The S&P also positive by 56.54 points, or a gain of 1.42%. We'll look at the sectors, all positive, no shaming here, although the laggards are the defensives, the risk-off kind of sectors, healthcare and consumer defensives. On the other hand, the leaders today led by risk-on. Technology at number one, capturing the gold medal. Real estate number two for the silver. Will real estate hold? If yields on bonds start to rebound, that is something to think about. But at number 3 for the bronze, we have cyclicals, so we have a clear risk-on trade today. When it comes to the breadth, we have the NYSE 76% advancing versus 23% declining. The NASDAQ 63% advancing versus 34% declining. The breadth, believe it or not, was pretty good today. And my hunch is we have a computerized program that bought a lot in end of the quarter rebalancing, so we saw a gap higher in the morning and then very little build up. So the retail mom and pops didn't even get the chance to hop in because the move already happened pre-market, and hence the possibility of this as being a rug pull. On to commodities. What do we see here? The dollar was a little bit higher, but again, if you look at the charts, they indicate that the dollar is going to rebound significantly higher in the days to come. And maybe commodities are sniffing that ahead of time because energy commodities were down across the board, be it modestly. WTI and Brent down a little over 0.25%. On the other hand, we have natural gas futures rebounding by about a little over 1.5%. Now, when we look at the Henry Hub, a weekly chart, what do we see here? It went down all the way in a retest to the February lows, almost to the penny, and then it bounced higher. So now we have the possibility of a double bottom. We know that the bearish momentum is peaking in natural gas. It's already beaten, bruised, demolished, and the only path available for natural gas is higher, and therefore I continue to like nat gas a lot better than crude as we head into the summer season. But since we have commodities sniffing a move higher in the dollar, be it warranted or not, we see gold, silver softening a little bit. The recession trade is moving down, especially gold, down by almost half a percentage point today. But muted reaction all in all for metals, for meats, for grains. We're not seeing a major move yet. But if you look at the leading indicators, look at the Japanese yen, for example, down big, down over 1.5%. Doesn't this say that the dollar is about to rebound higher? If the dollar rebounds higher, it's not going to be good for the NASDAQ. It's not going to be good for the big caps because the trimming of revenue growth alone will move these stocks down. Not to mention, of course, crushing the hopes of a Fed pivot. It all depends on what the dollar is moving higher based upon. Is it because we're seeing the unwinding of the recession trade, or we have hot inflation data, or even worse? What about both? Moving on to the big casino, the options market, what do we see here? The volume all in all was down. And the reason is the move happened in the pre-market. Nobody can do anything about it. You can try to short it, you can try to buy it, but you're not going to score either way because the move already took place. How much more does it have in the tank? That's number one. And if you're shorting it, the volume was way too low. We haven't seen volume showing up, so no gap and crap at least today. But if the dollar starts to move higher again, we're going to see volume showing up. We might see options volumes also recovering. But for now, despite being a slow day, the hottest table remains Tesla by far, at around 1.6 million contracts traded today alone. About 56.5% of those were calls. And at number 2, believe it or not, one of the hottest names so far in the stock market is Intel. And today the name traded about 700,000 contracts. About 68% of those were calls. And at number 3, Apple, with around 700,000 contracts traded today, about 52% of those were calls. And then, what about the unusual activities that took place in the options market today? We begin with the ticker UAL for United Airlines. Somebody sees the name pulling back and they bought the 38 puts for the expiration date, May 19th, with expectations the name will move down and lose more than 12.5% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $850,000. And then we have the ticker BBIO, and this is for a company called Bridge Biopharma. Now the name was up over 16-17% today based on rumors, and somebody sees more gains to come, or it could be an opportunity to raise some cash here by opening a credit spread. Maybe somebody's selling upside calls here. It doesn't matter, the trade has a buyer and a seller, so from the buyer's perspective, they see it going higher. And they bought the $20 calls for the expiration date, April 21st, with expectations that the name will add more gains, worth at least 14.5% by then. They paid around $1.65 a piece to enter this trade, all in all spending around $350,000. And then we have the ticker ARNC for Arconic. Now, if we pull up a weekly chart for ARNC, what do we see here? We have a declining trend with lower highs, and the trader is probably betting that the resistance line will hold up again. We will see ARNC pulling back, and therefore they bought the 24 puts for the expiration date, May 19th, with expectations that the name will go down and lose more than 10.5% of its value by then. They paid around 55 cents a piece to enter this trade, all in all spending around $350,000. And then what about about the ticker JPM for JP Morgan? And here we have somebody betting that JPM will recover the majority of the losses since the collapse of Silicon Valley Bank. And they bought the 137 calls for the expiration date, April 21st, with expectations that the name will move higher and gain more than 6.25% by then. They paid around 84 cents a piece to enter this trade, all in all spending around $500,000. Last but not least, what about the ticker COIN for Coinbase? Somebody's betting for more declines to come here, and they bought the $60 puts for the expiration date, May 6, with expectations that the name will move down and lose more than 7.5% of its value by then. They paid around $2.20 a piece to enter this trade, all in all spending around $1 million. On to the heat map. What do we see here? Green across the board. You can call it the end of the quarter rebalancing. Doesn't matter what the reason is. We saw gains across the board. Although if you dig down, notice that JP Morgan was a laggard when it comes to banks. Notice that Google was a laggard when it comes to big caps. And today we have healthcare absent from the rally because we have a risk-on theme all in all. We see names like Tesla, Amazon, software names, the regional banks, the high valuation, high beta names in chips and technology leading the rally. So today was a risk-on, but it was good across the board. But there is another theme that you might not be paying attention to right now, but notice the gains that we got today in agricultural stocks. Fertilizers, names such as Corteva, for example. Why are we seeing inflation-themed stocks rallying higher today? Is it because we're about to revert back into the inflation theme, at least for a little while? Maybe we're about to get a hot inflation reading. And if we do, we know the dollar is going to bounce significantly higher. But will that be bad for energy stocks? It might be bad for the commodity, but would it be bad for energy stocks? Will it be bad for fertilizer stocks? That remains to be seen. But I think what the market is not discounting right now is, what if the dollar rebounds? A lot of this heat map will turn red, starting with technology, software, the multinationals. So keep an eye on the dollar, because it happens to be the most important leading indicator right now. We will look at the heat map for the ETFs, again, all in the green for the most part. Very few exceptions here. We're talking about gold, of course, gold miners, the GDX, GLD, all down. So we have an unwinding of the recession theme, at least for now. And we see real estate rebounding big today. We see technology rebounding too. We see energy building on the gains from the last couple of days. We see the big caps catching a bid. So that remains the mystery here. Big caps rallied in the recession theme last week. Today it appears that we have the unwinding of the recession theme, at least for now. We see bonds down, we see gold down, we see energy prices moving higher, energy stocks moving higher, and somehow the big caps also managed to rebound. So what are the big caps rallying based upon? The safety because we have a recession theme, or the expansion theme because the Fed is about to pivot and cut rates and higher we go? This is yet another thing I'm watching closely. What are the big caps reacting based upon? But for now, we're moving on to cover some charts and then wrap it up. When we begin with the SPY, the S&P 500 30 minutes chart, what do we see here? If you can't beat them, you can cheat them. What am I talking about? 398 has been stiff resistance over and over and over and over again. And the SPY had a hard time. By the way, this is an hourly chart. You just noticed that. But the SPY had a hard time cracking above 398. Today got a little help in the morning to cheat by the gap higher. And it managed to go all the way to the next resistance at around 401.20. The problem right now, it is becoming a little overbought in the RSI, meaning it is susceptible for a pullback. If the dollar rebounds higher tomorrow, I can see the SPY moving down and undoing the cheating in an actual retest at 398. If that fails, down it goes again and it closes the gap. When it comes to the daily chart for the continuous contract for the SPY, it is a positive reaction because it is above a resistance line right now, which we have it at 4,037. You're going to see the Qs failed to crack above the resistance line, but the SPY did. So we have a positive breakout in the SPY. On top of that, the volume remains way too low, but this time around we got a rebound. So that's good for the bulls. The problem is what happens when the volume comes back. That is something you got to keep in mind. The momentum indicators remain positive and they're firming up. So the bulls would argue, what if this is a reverse head and shoulder formation? And higher we go to at least 4,100, if not 4,200. The problem for this outlook is if we look at the weekly chart for the cash index, the SPX, we see the opposite. We see perhaps the beginning of an actual head and shoulder formation, which is negative, not positive. So we have a conflict here. Daily chart looks good. Weekly, not so hot so. But two important indicators you got to keep in mind. Number one, the 200 days moving average. The SPX is above that. That's good. Number two, 4,000. And we have a closing above 4,000 today. So that's good for the SPX. So long as we have the chart above the 200 days and above 4,000, so far, so good. But if the chart loses 4,000 as support and then it loses the 200 days moving average, that would be a major shorting signal. What would be the catalyst for that happening? I can only see the dollar rebounding. How would the dollar rebound? We can see the unwinding of the recession play right now. We can also see perhaps an upcoming hot jobs report or a hot inflation report. Either will do the job. When we look at the Qs and hourly chart, what do we see here? Again, if you can't beat 309, you can cheat it. You can gap higher in the morning and pretend that it doesn't even exist. But the problem for the Qs is you got 313 and Mrs. 313 will not be happy by the behavior of the Qs. You got to go down to 309. You got to go down and close the gap. For now, the RSI is not really overbought, but getting close. And I say if the dollar rebounds, the gap and crap will happen. We're going to go down to 309. If that doesn't hold, down we go to closing the gap. Can the Qs continue to rally for a little bit? The answer is yes, but that is contingent on what? On the dollar continuing to go down. Now, if we look at the daily chart for the continuous contract for the NASDAQ, unlike the SPY, we don't have a break one way or the other. It remains consolidating within range. Support 12,766 and the resistance at around 13,000. The good news for the bulls is they're above the support once again. They lost it yesterday. They got it back today, and the question is, can they keep it by the end of the week? For now, we know that the volume is below average, so this is bullish for now until the volume comes back. The momentum indicators are firming up. The question becomes, can the Qs crack above and close above 13,000 by the end of the week? That would be a major bullish signal that we have more juice to squeeze in this rally. When it comes to the IWM and hourly chart, what do we see here? It managed to close above 174.22. So far, so good for the IWM. It is getting a little overextended in the RSI, meaning a rug pull could happen, but again, that depends on the Dixie. In the meantime, we'll look at the daily chart for the IWM, beaten, bruised, the bearish momentum is peaking. Now we're moving into bullish momentum, which could take us all the way in a retest of the highs of this pattern, this consolidation pattern. But I caution against indulging in any rally in the IWM. You can play it right now. I'm playing it via the TZA calls, or TNA calls, excuse me. TZA is the inverse index, but I'm fully aware that the IWM will go down sooner or later. The weakness is clear, the message is clear. Whatever rebound we get right now is a relief rally. And here it is, the Dixie 4 hours chart. We talked about it in the intro. Now we have to look at 103. If we have a closing above 103 from a 4 hours perspective, then the message is clear. The dollar is about to rebound higher. We're about to see a lot of unwinding on the bullish bits for the Japanese yen. This will exacerbate the move higher for the dollar, not to mention short covering in the Dixie itself. That will exacerbate the move higher. And a big pop in the dollar will not be good for equities. It will be a wake-up call because the dollar is going to rebound based upon high inflation expectations and more Fed tightening. It demolishes the entirety of the argument by the bulls / the babies. What about gold, the old man? The daily chart, what do we see here? Losing momentum, negative divergence on the RSI, about to cross in the MACD indicator, producing negative impressions on the histogram. But the question remains whether gold will keep 1928 as support or not. If it does, so far so good. And I would say even if it goes down to 1900, so far so good. But anything below a closing on daily basis below 1900, it will mean that we got an overreaction based on the recession theme, and now that's being washed out. It will only happen this way if the dollar rebounds higher significantly, and the dollar is not going to do that unless we have hot inflation data. So all of a sudden, the market would say, hey, wait a minute here. The recession play is a little overdone right now. It's a little too premature. We have to deal with inflation. And then comes the recession play, which means all in all, if you bought gold and you go down, it's not the end of the world because gold is going to rally sooner or later. The question becomes, is it the right time right now or maybe a few months from now? When it comes to silver, SLV, look at this, doing a lot better than gold. And it closed almost positive for the day. It ran a retest to 21.57. That was a no-go for now. I'm watching whether silver loses momentum and consolidates above or below 21.57. Above bullish. If it is below, we're not going to say bearish, but we're going to say it is gathering momentum and energy to crack above resistance once and for all. But the problem is if the bearish momentum leads SLV down by a lot, if it goes down to 21, if it breaks 21, then we got a problem here. So I'm keeping an eye on SLV. What about UK oil, the daily chart for Brent? It is above 77 for now, but it closed at the lows of the day, reversing the majority of the gains and actually closing negative. And we got 2 days left till the end of the week. The challenge becomes, will Brent oil close above or below 77 by the end of the week? If we do have a revival of the inflation theme because we get a hot PCE on Friday and the dollar rebounds significantly higher, the likelihood is UK oil is going to close below 77, and that will not be good for oil stocks. We might actually see another phenomenon if indeed we get a hot PCE data and the dollar shoots up higher based on expectations that the Fed will have to tighten more. And this phenomenon is the 2-year yield blasting significantly higher, perhaps all the way to closing the gap at around 4.59. But we might see the yield in the 10-year, on the other hand, moving down or not as high as the 2-year, meaning a re-inversion of the yield curve. Why would the bond market react this way? The answer is, if we have a hot inflation reading, it means the Fed will do more. And if the Fed is going to do more, the probability of the recession increases even more. Because in the process of raising rates higher to tackle inflation down, sticky inflation perhaps, they're going to have to break something bigger than Silicon Valley Bank. And the recession becomes more aggressive. So we could see the 2-year moving higher based on, the Fed will have to hike more, but the 10 lagging or even moving negative based on expectations of a deeper recession. And that could be good for the TLT, but for now, the charts are saying, if we're looking at the momentum indicators, the RSI, the MACD, they're saying the TLT has further downside to go, which means the 10-year will likely react positively, but not as positive as the 2-year if we get a hot inflation reading. So for now, I'm not in a rush to buy the TLT. I know a lot of you are stampeding to buy gold and the TLT right now. In my assessment, we're going to get plenty of opportunity to buy the TLT and gold in preparation of the recession. The VIX 4-hour chart, what do we see here? Again, a weird phenomenon of a gap down and consolidation in the VIX. The computers decided to gap higher the SPY and consolidate till the end of the day, maybe a little pump higher by the end, and gap down the VIX in consolidation, which you could say this is a bear flag pattern. The VIX will go down to 18, but I say the beginning of a rug pull here, fooling everybody. The indices gap higher, the VIX gaps down, giving everybody the false sense of security, and then the dollar rebounds higher, and here we go. Fear is back in the market, and the VIX explodes higher. That's my call for now. And then we have an hourly chart for the big kahuna, Apple. What do we see here? Gapping higher, closing at the highs of the day. So we know what they were buying in the end of the quarter rebalancing. They were buying a lot of Apple. Why are they buying Apple? Are they zombified? I showed you all of the negative growth in revenues, net income, cash on hand. Of course, they're buying Apple because it is safety. It works as safety, at least for now. And it also works if we have an expansion theme, if you believe that the Fed is going to pivot and start a new bullish cycle. That inflation will be averted, recession will be averted, and the Fed pause or rate cuts will save us all. Apple works for now, until of course it doesn't. And my hunch is, once again, this is the beginning of a rug pull. If we get a higher dollar, Apple will flush down. It will lead the NASDAQ down. And if it does, we have target number 1, closing the gap, of course. And then we go back to the support number 1, 156.30, support number 2, 153.69, then 152, and then 150. But what if Apple continues to move higher? Do we have a target here? The answer is yes. We look at the daily chart. We have a descending line of resistance forming lower highs. If Apple wants to move a little higher, it can go all the way in a retest of this line, and that would be at around 164, 165-ish, and that would be a slam dunk shorting opportunity, because by that time, the daily chart will also become really, really overbought, and last time we got a decent pullback when the RSI became elevated. When it comes to Tesla, 30 minutes chart, what do we see here? We know right off the gate that 194.55 is a stiff resistance for Tesla. It tried many times to crack above it and stay above it, and it failed. So there was an attempt for a cheat in the morning. The SPY cheated, the Qs cheated. Why couldn't Tesla? Tesla cheated by a little bit, but couldn't close above 194.55. The good news is we have a triangular pattern of resistance, lower highs and higher lows, and by the end of the day, this pattern was broken to the upside, which opens the possibility that perhaps by tomorrow we could see Tesla bulls giving it another shot at 194.55. It could happen. And then 200 becomes the next target once again. When we look at the daily chart for Tesla and we use a line chart, what do we see here? We have a bullish trend line that was broken. It was a false break once, but then we had another trend of lower highs. And Tesla broken the support line once and for all. And then it formed a bearish trend line of lower lows. And last year, Tesla went all the way to the lower end of this channel, retouching support, and then this year caught a massive rebound from that support, and now what? The bulls would argue, look, this is a consolidation pattern of a reverse head and shoulder. we're going to go all the way to the higher end of the channel. That requires a lot of multiple expansion. It requires the dollar going down a lot. It requires yields going down a lot. It requires the Fed cutting rates by a lot. So the bears would counter and say, wait a minute here, all what you've done so far is redo the overreaction perhaps in the sell-off in December of last year. That's all there is. And now the chart is actually consolidating in a bear flag pattern, which will break down and we will go all the way in a revisit of the same trend line, forming a lower low. Each side right now has a valid and persuasive argument, at least from a technical perspective. Forget about the fundamentals. And the momentum indicators, be it the RSI or the MACD, are saying it could go either way. So for now, Tesla remains a battlefield stock. Recently, the bears caught momentum from the bulls' hands. Can the bulls make a comeback and regain momentum? The answer depends on the dollar. If the dollar rebounds higher this week, next week, it doesn't matter what time it is, it's going to be hard to see that Tesla is going to move significantly higher from here, and the bears will gain more momentum. And the same goes for Bitcoin. Last but not least, decent rebound today, still above 26,555, but how will Bitcoin react if the dollar has a significant rebound? That remains to be seen, because for now the RSI is in negative divergence. The MACD indicator is about to cross to produce red impressions in the histogram, so we know that the bullish momentum is tapping out for Bitcoin here. And hence, we go back to the theme of this video. Is this the pop that we got today in Bitcoin, in the indices, the beginning of a rug pull operation? Keep that in mind. And here are some few bonus charts for you by popular request. Amazon, a daily chart. We have support at 97. And we have resistance at around, let's say, 111. You can round that down to 100, of course, the obvious number that everybody's eyeing. For now, the chart appears to be forming a bull flag pattern. That is playing out for now. The bulls will also argue that this is a reverse head and shoulder formation. Higher we go. The bears will counter and say, look, we got a harsh reversal from 111 somewhere around this number. And could this be a formation of a reverse ABC pattern that will take us all the way back to the lows at 81.30? The bears will argue also, if we use the weekly chart, we could see a giant bear flag consolidation pattern. Sooner or later, this is going to play out and Amazon will go down. Which argument is more persuasive right now? The bulls could say, look, a lot of technology names rebounded significantly higher. If we look at the heat map, for example, the 1 year performance, meaning going back all the way since March of last year, most big caps recovered a lot of the losses. Amazon is still down 40% plus. So maybe Amazon has a lot of catching up to do here. Maybe if you tell me that the Qs will close positive next month, I would say it should be led by Amazon. So we can easily make an argument here to say that Amazon will move higher from this point on. The problem becomes, what if the dollar rebounds higher? We're not out of the woods yet, folks. If the dollar rebounds higher, say goodbye to Amazon too. And then what about AMD, a daily chart? A lot of you want to short Nvidia, but understand this, Nvidia and AMD been trading together. If Nvidia moved down 3%, AMD is doing the same. If Nvidia is moving up by 2%, AMD is doing the same. But the premiums for Nvidia options are more expensive than AMD's, even though they move at the same percentage points, at least for now. So let's say that you're betting Nvidia will move down by 5% by whatever expiration date. Then the assumption should be AMD will do the same. And should you overpay for Nvidia options or take advantage of AMD's cheaper options instead? I'll leave this answer to you, but for now, what is the chart saying? We have a curve support pattern, a saucer support pattern with higher lows, but the momentum indicators are topping out and they're moving down in negative divergences, indicating bearish momentum to come. If the assumption that we go down to the same support of the curve, it depends on how fast we're going to go down there. If it's a rug pull, for example, and we go down fast, that will be a decline of about 8.5% from today's closing. If it takes a little bit of time to get back to the support of the curve, let's say by April 17th, for example, that would be a downside from this point on of about 4% or so. So keep an eye on AMD. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have initial jobless claims, and we have a lot of Fed zombies speaking. From Boston Fed President Collins to Richmond Fed President Barkin, and most importantly from Minneapolis, Neil Kashkari. I want you to take a shot and guess what they're going to say. The answer is inflation remains a problem. We're not going to cut rates anytime soon. We're monitoring what's going on with banks. things are stabilizing, the banking industry is pretty good and healthy and blah, 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 blah. But you're not going to hear, oh, we're going to cut rates. And the reason is the market is delusional. The market is rallying and giving the Fed the cushion to continue to be aggressive. You want the Fed to pivot, you want the Fed to cut rates, you gotta play dead. You gotta be battered, bruised, down 10, 20%, and then the Fed says, okay, we're too afraid we might crush the stock market. But so long as the market continues to rally ahead of the Fed in anticipation of the Fed pivot, we're actually risking, even if it happens, we're risking buy the rumor, sell the news. In the worst case scenario, if it doesn't happen to begin with, because inflation remains sticky and too high. And with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again over the weekend. Take care.
You have a great name. You must kill your name before he kills you.